Welcome to the Real Estate Show on KMED. May 21st is our day. Pete Belcastro and Joe Brett, the real estate guys, with you. We're both real estate brokers with John L. Scott in Southern Oregon. We get together with you once a week here on KMED to talk about all sorts of real estate-related issues and topics and substances that have gone on since 2009. Well, today, though, we're going to have a different topic, Joe, which is always exciting that we haven't really done. So, we just keep learning. And, of course, we've got the smartest real estate listeners, smartest real estate consumers in anywhere who listen to our show.
We've not run out of topics by a long shot. We've got another great one today. You're right.
Well, we've talked, we're with Don McCoy is here, too, from John L. Scott. Don is an old radio guy and one of our old friends and been a real estate broker, one of those post-media guys, right? I mean, I love that story about you.
We go back in radio a long ways, Pete.
Yeah.
Being in real estate, it's all about networking and who you know. And so I met some people through the years, some wonderful, wonderful people that know somebody that knows somebody that knows somebody.
Yeah.
And we have them all here in the studio with us today.
Yeah, is that true?
It's pretty cool.
Yeah.
And we have a really interesting, very interesting guest today, and he's going to be teaching us some things about private money lending that is unbelievable, and different stages of opportunities for investment for people out there that are just wondering where to put their money.
Yeah. Now, a lot of people, when you say private money, private money, we're not talking about, Guido down the street who you go down to and you need some money, right? You need a loan. We're not talking. We're not talking that connotation
I'm not
of
in that
that,
networking
is it?
circle. That's not my networking circle.
That's more, I think, in your family's past histories.
Yeah, that could be. You may hit that right on the nose. Anyway, you want to do that. But that's not what it is. But the issue of private money, private lending is something that we've not talked about. And so when Michael Weintraub was able to come join us today, he's the CEO and president of Dollar Brains, Inc. So first of all, Michael, welcome to the show, and welcome here to Medford, I guess.
Thank you very much. It's great to be here.
Now, you do your own thing too. I mean, you're new to this. You're not new to this. You're like Dawn. We've been around a long time, right?
Long time.
Yeah. Well, so tell us off here about private money. I mean, how?
Let me kind of give you
give me a hint of
background.
what does that mean, private money, and where it comes from, and how did you get to what you're doing?
Let me. I come from an entertainment family of 3 generations. My dad was the largest concert promoter in the world at his time. He managed Frank Sinatra, a lot of acts, and he produced the tours for people like Elvis Presley. We did the Asian tour for Michael Jackson, the Thriller tour, and then we moved into the movie business because of my mom. The other side of the family's history in movies, but through that experience growing up around high net worth employees and subcontractors, i.e. actors and or athletes or singers. So I'm growing up and we're seeing guys that live in Beverly Hills for a few years and they leave. And my dad tells me when I'm 8 years old, do you know the difference between the guys that move here and stay here and the guys that come in and leave? What we do with our money. The first thing is, what do we do with our 24-hour day? The difference between people that live in Beverly Hills, 90210 and East LA is what they do with their time. And what we did was we just always acquired real estate. So you make $40 million on a concert tour and merchandising. You set up your companies and you go buy apartment buildings or you go buy trailer parks or you go and become the banker of the people that have to be renters. And so I had an interesting perspective from the inside on the other side of the railroad tracks, literally. And so growing up, I migrated toward that place. I became the president of Darryl Strawberry Pro Sports when I was 23. I got Darryl and a lot of athletes together, and I married rap music and sports, and I started producing those Chicago Bear rap record albums, those one-hit wonders that sold 1 million copies.
So these guys invested with
Right.
you? Is that what that?
What I
how
did
that
was
come to it?
Yeah. Here's what happened. I just practiced what I learned in the country club in Beverly Hills at a Jewish country club. It goes something like this: "Hey Saul, how much do you have liquid?" "Oh, $1.5 million. Why?" "Hey Bernie, how much do you have liquid?" So that's what I grew up around. Guys are always wondering who's liquid and who's got what because they have a deal. They might have spent their last $250,000 on an option on a piece of property in Cahuenga, but they're going to go get Bernie and Saul's $3.5 million to tie up the deal. They're going to flip it. Bernie and Saul are going to get their 12%, and the other guy's going to make $2 million that had nothing in it but the option money. So I assimilated this information, roll the clock forward. Darryl Strawberry and all these young athletes in their 20s, everybody that they knew that knew nothing about money comes to them.
Yeah.
Hey, we should open a nightclub. Hey, I want to open a nightclub. Why do young athletes all open nightclubs? Because they want to control the women in the city. They want to have a place to go. That's what it's about.
It's home away from
It's
home.
hormonally driven. It's off the field.
And restaurants. You want to
restaurants and
too,
nightclubs. Let's take $3 million of your 5-year contract. Back in the day when it was only maybe $7 million for 5 years. Shame, huh? Mm-hmm. But let's take $3 million of your 5-year contract and put people that you know nothing about in charge of the money that you never see and hope you get paid. Oh, and let's have you sign and pledge the rest of your contract for the building and the rent. So if the thing goes down, your income's attached if it doesn't work.
That's not probably a very good deal. But
not a very good deal.
How many people
And
do that,
ESPN's 30 for 30s are full of stories of athletes that have just taken the plunge like that.
Over 87% of athletes statistically after their playing career will end up broke or bankrupt.
And that's true. Did this led to you then to create a business?
Yes.
To expand this
Yes.
to allow other people to invest
So
this type of way? Is
let
that
me
what you're
take
talking
you to
about?
present day. So I
Okay.
get the athletes together and I start hypothecating the values of their contracts to buy big pieces of property and things of that nature. So I'll take an Eric Davis and a Darryl Strawberry. I'll take the value of their contracts, the retained guaranteed value of their contract. That's bankable. Even though their credit scores were horrible from not paying their cable bills or their pager bills, you're laughing because you know what I mean. They're young guys. They don't follow up on this stuff. So they have horrible credit scores, but guess what? Between them, they have $8 million in guaranteed income over the next 3 years. A Hebrew kid from Beverly Hills can do a lot with that.
You found Saul.
I found Saul and Bernie, and I said, Saul and Bernie, how did you do that? So what I would do is I'd say, you know what? We're going to hypothecate your contract in buying and accumulating properties that are asset performing, not speculation on land up on the side of the hill that in 7 or 10 years might be rezoned. No. Assets that were underperforming, like ghetto apartment buildings and areas where people get shot if the rent's trying to be collected. So you switch them to Section 8 and let the government send you a check and you can power wash the 99-cent Home Depot floors. So with that being said, my deal with the athletes was a win-win, and here's what it was. I don't need a piece of your contract. I just need to work with you on your money, and I want 30% of all your off-the-field income that I create for you, not the ones that the phone rings. So Dan and Yogurt, the Grand Slam meal combination, I'm going to go earn you money, but I get a third of it. You following me? Then I translate that into real estate. If I make you money with your money, I get half of your gain above 5% a year. 5% a year was the effective rate, a decent median return outside of a baloney New York life insurance policy with phony illustrations that are never going to happen. Whoops, you're in good hands with Allstate. Just don't file a claim. You know that stuff. And so I would take their baseline money, hypothecate it, find the assets. Now, I disclose that I got paid on the buying of the assets, always got my commission on the purchase. Then they got their 5%, and then we split 50-50 the gains. You following me?
You lost me. You lost me along the way here. I'm just trying to get back to you about.
I put them in first trust deeds. They were the banker.
Why would I come to you? Why would I come to you today for something? If you in your business here at Dollar Brains,
right?
And I've been on your website. If I come to you, what are you offering me?
Depends on what your scenario is. Are you 70 years old and you're a retiree and you have a bunch of pension fund stuff maturing and you've looked around and you don't really want to go into the market because you know it's the micro traders and all the things on the emotions of the market aren't tangible to Warren Buffett and Benjamin Graham's theory.
Okay.
It's too volatile now, so you're not going to risk your future income and end up eating cat food or working at Walmart as a greeter at 90 because you want something to do.
Okay, what would I do? What would you do?
So what I would do with you is I'd give you two options. The first thing I would tell you is you're 90 years old or you're 67 years old. Are you in good health at 67? Yeah. I tell you need to go get a cap rate of 12 to 14 and buy yourself a duplex. If you don't want to do that, because guess what's interesting? Less than 8% of the population, even affluent people, want to buy income-producing property that's residential or multi-residential. Ask me why.
Okay, why?
Because they don't want to be in the situation of what they were taught by people that had a wrong relationship with money and taught them that wealthy people were greedy and mean and rotten if they grew up in middle America. They don't want to have to kick a single mom out of her apartment if she doesn't pay the rent. They don't want to be consciously connected to someone else's destiny.
And that's why
they don't want to have the payment not be made.
And that's why they have property managers, so they can go in there and do the dirty work. Meanwhile,
and lose 10% of their income, and it probably doesn't balance out because the real estate agent sold them the thing at a premium because they didn't know what they were doing to begin with. And the only guy that made money were the brokers.
and meanwhile, Pete and Joe.
Wow. I don't know if that one's
Meanwhile,
accurate.
Pete and Joe, the reason why Michael's here is because he knows a good deal when he sees one. He sees Southern Oregon, and he sees opportunities here. And so we're uncovering some of those opportunities, and we're looking for more.
Well,
and they've got to be good ones. They've got to be good ones.
You were talking about that you would buy, that you would invest in what? A duplexes, apartments.
Okay, let me
12% to 12% gains.
My cap rate in Nevada are 19 and 20.
Really?
I buy stuff that is so horrible when you see it. Burned out units where people never fixed them and pocketed the insurance money.
There's lots of that
Third
out
generation people that inherited property that's going to be upgraded and rezoning, and they live in there, and their lifestyles are horrible because they never made the money to begin with. They were trust fund sucklings at the last end of deterioration. I go in and bottom fish. I turn those assets around and get them habitable, fix them up. I'll spend $20,000 to fix up something and develop a $700 income on $20,000 fix-up fees. So you're the guy that doesn't want to collect rent. You're the retiree. Do you go to Umpqua Bank? Whoops. Yeah, I want 1.05% on a 3-year CD. And I want to, after I get $3,000 a year on my $300,000. What's that going to do for me? $250 a month. Oh my goodness!
Am I going to come to you to ask you for that type of thing?
Because yes, you are.
Because Michael, we've had many people in here, Joe, in our shows, who come in, and the contractors. Remember, they're coming in here talking about, if they invested money, what would they invest it in? Duplexes, fourplexes, triplex, whatever that they are.
Apartments, many-storage units.
Because look, we have a terrible housing shortage in our county. Our rental rate was 1%, less than 1%. The costs are going up. I mean, look what's happening to
it.
us.
The demand is going to grow.
That's why I'm here.
Do you come in? I mean, do you actually invest in the actual projects themselves, like an apartment complex, those types of things?
So let me
tell
say
me how
something.
That would work.
So I see a piece of property that you guys already have all the zoning for multi-residential because of your shortage. We know through the city council and everything, we're not going to find some spotted owl crawling on the back or a beetle or these crazies from Southern Oregon and these eco-terrorists that wreck business. Anyway, I don't have any opinions on things. I'm not a Republican either. But anyways, the bottom line is, I look at something, I do the math, I crunch the numbers, I look for cap rate. Now I come back to you, the 67-year-old retiree with your $300,000, say, John, I have a fit for you. And here's the fit. John, I've created a product called the Secured Yield Certificate. It's a proprietary mortgage product I've reverse engineered. And what it is, John, is I'm going to pay you $17,500 a year, 5.5% tax-free income versus your Umpqua certificate of depreciation at $3,000 a year that you're going to pay income tax on. Why is your product tax-free, Michael Weintraub? Because we are looking at you having your income now and leaving an inheritance to your children's children, as Proverbs says to do.
Because you have the asset. Is that correct?
Because you can kick and touch the asset. And now John, the 67-year-old, is the private banker, first trustee holder of a mortgage. We just circumvented Umpqua Bank, who's going to take your $300,000 and loan it at 42 times your deposit to the tune of $12 million and hope that people pay and hope you get your 1.05% tax.
Now, if you're going to beat up on Umpqua Bank, you could at least get their name right. Umpqua Bank.
I don't even want to say
and they're not the bad ones.
Umpqua.
I mean, they're not the rough ones. The roughnecks are.
You got to pick on the biggest guy in the region.
That's
the only bank I know up here other than Chase.
My own experience with banks has not been, very pleasant, and you think that you've got them in every time. But what you're talking about, Michael, is in terms of the investment with you. It's a tangible asset versus throwing money into the stock market.
I'm a Jewish dating service. I marry your money with an asset that you can love and touch.
Yeah, and I think that makes a lot of sense. Joe, okay, go ahead.
What about someone in a situation where had a foreclosure they signed, say with a child?
Wow.
And now their assets are strong, their credit's great. This situation didn't work out because the employment opportunity for the child involved didn't work out.
Gotcha.
But now they want to invest in property. Now they've come into some money and they want to invest in, but They can't get
Here's the deal.
They can't get a mortgage.
Here's
They
what-
couldn't get a
of
loan. Your
foreclosure.
friend
No.
could not get a loan.
Right.
Don't you guys understand that there isn't not a conspiracy theory about the middle class being destroyed in America? Don't you understand that the whole economic system and the meltdown of it and such is to prevent the transference of wealth to this generation of us baby boomer age kids who have parents in their 70s? Here's the real bottom line. The banking regulations have been tightened specifically to constrict the migration from middle-class individuals to increase their economic viability in this country. Because of what? The crazies, feel the burn, the crowdfunding people of the redistribution of someone else's money. So anybody that has a few $100,000 shouldn't even be going into the banking system, because that's the people that collapsed your future now retook your asset back and bought it back through their own holding companies and sat on them for 4 years until they drove the market back up. That's why they're leaking the properties out.
Yep.
We got to go.
They killed your dream, and now they want
boys.
you to give them. They want to give
All
you
right.
1.05%. So here's the answer.
Hey, you're gonna have to hang on there. Tangible assets they are, because it's better than the stock market, no matter what anybody says. The Real Estate Show rolls along here on KMED. We've got a break coming up. We're with Michael Weintraub. We're coming right back right after this. The Real Estate Show rolls on KMED. May 21st is our day. Pete Belcaster and Joe Brett, the real estate guys, with you. And thanks for joining us here on KMED. Don't forget, you can catch all of our shows, both from our radio shows and our cable TV shows, at realestateshowOregon.com. They're all there for you, and hope you get a chance to do that. We just finished a TV show. Congratulations again, by the way, Joe, to the Southern Oregon Land Conservancy. They got the $1.4 million loan from the, not a loan, a grant, I should say, from the Oregon Lottery and the Oregon Watershed Council for the purchase of the 352-acre Rogue Ranch up at the Conservancy. Remember that, that show?
100 years from now, think of what's going to be surrounding that Conservancy area, and think of the pristine nature it's still going to be in. What an investment in our future, and what we really love about the area we live in.
It was the biggest grant that they've ever given out, and so it was over. Well, they're only $1 million short now of the purchase, but
Patrick Duffy
they're well on their way.
For us.
They're well on
Get
their
Jim
way.
Belushi.
Yeah,
He'll raise
Jim
some
and
money
Pat.
for it.
Jim, it's well, he lives along the Rogue River. Jim does, along with
Hey,
Patrick
I'm working
Duffy,
on getting him on the show.
That'd be
so
really
we can
good.
talk about his green home he built on the river.
Yeah.
In the meantime, we're being overregulated to death, and it's raising the cost of new construction and building across the nation about 14.6%. The National Association of Home Builders reports.
Yes, it is.
Because of government regulations.
Yeah.
My gosh.
Brad Bennington told us.
I hope everybody's happy about that. I'm sure not.
Brad from the Southern Oregon Builders Association told us it was about $36,000 in fees for a new home in 2011, up to $84,000 now with these new regulations, which just pushes the price out of the range of a lot of people that we'd like to get into homes in our valley.
So we're talking today about how to circumvent some of these issues and these concerns that we have out there. We have got a loophole. We're talking about it right now.
Mm-hmm. And that's private. What is it? Private lending.
That's right, private
money
lending.
That's available for people who need it.
That's right.
And now I had a private lending case recently with a fellow who we went to a private money. This was a small loan for a bridge loan to kind of get into the new house and stuff like that. But we're talking more that there's so much more to it than that, right? Okay, you had a question for Michael Weintraub, by the way, who's our guest today on the Real Estate Show. Michael is the president and CEO of Dollar Brains, which is a private lender. Okay, so you had a question for Michael as we were going to that break there. Go ahead and ask him that.
Was a client who was solvent, who was actually sitting on a pretty good income right now and is retired, but had a foreclosure and a cosign with one of his children
years
4 or
ago.
5 years
has
ago, but
lots of money.
Still to this day,
he's
hamstrung from being able to go out and get a mortgage and be able to get into the house. He wanted to look at some duplexes, and sure enough, that foreclosure is just going to keep him out of the game for another year and a half or so. But he's got the credit score, he's got the wherewithal and the assets and the ability to get into the game, but just can't do it through that traditional means.
Dr. Michael, what do you have to say?
So here's the issue. His situation is one that's very common because when the markets had to correct from the collapse orchestration from the powers that be, overregulation came in the adjustment. So then it becomes ridiculous. You have a $14 million piece of property in the middle of Medford worth a fortune, and if you had $5 million for infrastructure, it'd be worth $40 million, right? When it made sense, you would get the loan with no problem to put your infrastructure in and triple the value of your asset, right?
Sure.
But now with this particular guy's scenario, because of overregulation, he's been locked out of the market. And
the
so
traditional market, right? You guys are talking about the traditional market. You couldn't get a loan from.
Right.
Okay, all right.
So here's what we look at. I don't look at the guy. I don't really look at even his credit score at this point. I look at his income producing capability, and I don't look at his debt loads or anything else, because here's what I believe at the end of the day. The first and only thing he's going to pay this time is the mortgage. That's what I look at. So if he has 20 to 25% in value in his subject property or the cash to put down, we're going to loan him the rest.
Mm-hmm.
We're going to loan him the rest, and we're going to do it in a way in which we make money and he has an opportunity. We're going to probably charge anywhere from 3 to 4 points for initiating that marriage between the dating service of the funder and him.
Yep.
Secondarily, we're going to increase the yield spread. So if we're representing to the investor, they're getting a 5.5% effective rate, he's going to pay us 6.5 to 6.75, depending on what the market will bear in his scenario. Does his scenario make sense and pencil out? If it doesn't, I'm not going to do the deal with him or for him, because I don't want to bury the guy.
Right.
I'll move on. There's plenty of other opportunities for me to put that other guy's $300,000. Makes sense?
Yeah, it does. Yep.
Okay. That was good. What if I come to you as I have been turned down I just want to buy a house, and I've been turned down by banks for whatever reasons. You could be, it could be anything.
Let me give you a great
Can
scenario.
you do that?
Let me give you a great scenario. 4 kids in a family. Parents' home that they grew up in worth $600,000. Parents both deceased. The other 3 kids are all stable. They own homes. They have everything. The black sheep brother that never gets anything right. He has 2 wonderful children and a wife that's stuck by him. The pie in the sky guy, the deal of the day guy. One thing about him is, let me tell you, this particular gentleman has 1/4 of that $600,000 home. We're going to have to readjust the value of that home by 10%. So we're going to call it a $550,000 home, okay? We're going to let him hypothecate his inheritance part of it. This is a big thing right now.
Yeah.
He wants the home. He's never going to qualify for anything. His brothers and sisters aren't giving him any of their money. They don't even like the guy to begin with. He's that guy. The parents would love for him to have had a home. They get bought out by us, the investor. He's going to pay $15,000 to $17,000 to our company for that. And now he's going to have a home which is in the payment range of the rent that he's been paying.
Man.
Done deal. Slam dunk.
And he starts to build equity.
There he is.
All right.
He's got instant equity.
All right.
That's a big scenario for the transference of wealth for heirs to get out.
Same
that don't
thing
have
that
the
you
capacity.
did with those guaranteed
Yes.
contracts.
110%.
See, look at all the different scenarios that
Would a
people-
bank
that people
even look at
face
that
out
law?
there.
Could a bank even think about that? Would they even
No.
look
No,
at that?
they would
would
not
they
do that,
even?
would they?
Would their minds even go there anymore?
No.
They wouldn't.
They're in
they
a
would not even
box.
do that
They're in a
at all.
constricted box with little holes being poked in the top by a manager who's controlled.
All right.
Your local banker isn't who you need to be mad at anymore. The guy that you've known for 30 years and he knows your cash flow and everything, and he turns you down for a loan, and what are you going to do? You're going to move all your money out of the bank and go across town because you're ticked off. He has no control anymore. Friends, it's a new world. It's all changed. So Umpqua general managers and branch managers aren't to blame. Corporate, New York, Federal Reserve, hello.
Well, they have changed. I mean, the rules have changed in lending. I mean, we know that, Don. I mean, we've had lenders in here also. The biggest change from them has been that the rules have changed in terms of how you get a loan, right?
Oh, they have. They've really tightened the screws down, so to speak, and they've affected a lot of deals
But by doing that, they've just
lower
cut a lot of
appraisals.
people out of the
Yeah.
market, right? I mean, that's
They've
the
killed the
problem.
market. They've slaughtered the baby on birth.
Another way to put it. I can't think of a more graphic way to put it, but
They've wrapped the umbilical cord around the builder's head and choked him.
there's the more graphic way to put
That
it.
was. Yep.
Yeah. Well, Joe has been to so many of the hearing. I mean, the public hearings, the planning commission hearings of developments and things like that. Is there land available in our valley that he's talking about that something like that could do in terms of large projects of that?
Yeah, we're just in the whole regional planning process and the urban growth boundary expansions. City of Medford hasn't quite nailed it down to what it's going to be yet, and it hasn't got through the state land use process.
For people listening out there that are catching a bit of a vision of what we're talking about, they just need to give us a call, and we will direct you to the proper channels.
Yeah, well, we'll give that at the end of the show. We can
No,
let people
let's do
find
it now,
you that to get you.
People
be
are
able to
chomping
do
at the
that.
bit. What am I going to do? I got to get out of the stock market. I'm out of the stock market. I've just lost enough money. Now what am I going to do with the rest? What am I going to do?
Listen, friends, I want to come back to the age-old adage. If you can feel it, touch it, kick it, smell it, and see it, and it's not on a brochure, you can actually drive by and visit it, get a first trust deed. That's the only thing you should do. Let's look at an economic collapse that could be coming, hyperinflation on the forefront in 3 to 5 years. Look at Greece. That's America if Hillary gets elected.
And you talk about though, Michael, of
But
the
we're not a
first deed.
political
The first
show.
deed is the
Not at
biggest
all.
thing, right?
What?
Is getting the first deed, your name on the
First trust deed.
correct?
Listen,
The first
I
trust
don't
deed.
sell second trust deeds. I don't want a second trust deed because if I'm a retiree, I'm putting them at jeopardy. If they don't have the cash to make up the difference on the first, they're gone again.
Absolutely.
Follow me.
Agree
You
with
guys
that.
agree with me?
First,
Forget seconds.
Yeah, absolutely.
Yep.
Guido can give you a second.
Yeah, Guido give you a second and a third, too.
Yeah.
Hey, the Real Estate Show rolls on here on KMED. We've got one more segment to go with Michael Weintraub. We're talking about private money, private lending in real estate, and there are some pretty interesting things today. We're coming right back to KMED. Hey, right after this. Real Estate Show continues here on KMED. May 21st is our day. Pete Belcaster and Joe Brett, the real estate guys, with you. Don't forget, if you have any real estate questions, we're happy to answer them during the week. You can call or text us. Our numbers are at realestateshoworegon.com. We'd love to hear from you. Lots going on across the real estate market. And as we head into, my goodness, I can't believe it's like Memorial Day is like next weekend. And then it's like summer. That's amazing.
I'm just trying to kind of regroup here. I feel like I'm back in algebra class and trying to wrap my head around some really fast-moving information.
I tell you.
Some numbers that are crunching. But, man,
Yeah.
it's great information. Our listeners have got to be really excited for what they're hearing.
Whoops, I'm sorry.
That's why I'm saying we've got to lock down on finding this show and listen to it a few times so that you can really catch the vision of what's going on here. There's a reason why Michael's in town. There's a reason why he's here.
Yeah,
he loves Southern Oregon, and he can see the value here. And we're uncovering deals that have been hidden and locked away and forgotten about for a long time, and we're taking a really good look at them. So they need to give you a call, Joe, and you a call, Pete, if they don't want to call me. But let's figure it out and see if they're any good.
Well, it's interesting to see what is out there. And Michael, Michael Weintraub, by the way, is our guest. He's the CEO of Dollar Brains. We're talking about private lending, investing into real estate. And what the big thing I've heard today is that, and it's true, and we've talked about this, is if you're going to invest your money, you're going to put it in the stock market, or you're going to put it into something tangible, which is real estate. And that's certainly the demand is there, and the returns are there, and it's tangible, and you can touch it.
I don't know.
I love that. You can touch it.
I
love that.
want to just wake up in the morning and look in the paper and see if I've made or lost money. That seems like an easier route.
I have a question for you. Banks are selling a product that I call affectionately certificates of depreciation. And here's what my dad used to say. When banks start buying them, we'll buy them too, Mikey. Mm-hmm. Banks sell them. Mm-hmm. And so let's reduce it to the ridiculous before we close here today. You can get into a REIT. Oh, I'm going to get tax-free money. I'm just in another Wall Street tricky math fund at the will of some brochure and some glossy presentation produced by a bunch of people that I'll never meet, that don't know me from Adam, but they can have $1 million of my money, and I hope they pay me my 5%. But if the market fluctuates in the little print that you couldn't read with an electron microscope, if the market fluctuates, you could lose everything. But isn't it interesting in those funds, the guys that run them still make millions of dollars a year, and they have expenses of their lifestyles and their wife's 50th birthday party in Jakarta that cost $1 million because it's a promotional event? I mean, here's the deal. Let's get down to it. If you cannot be involved in a first trust deed, sorry, builders, not seconds. Don't buy seconds from your builder friend. First trust deeds only. First trust deeds. If you cannot,
first trust deeds only.
Trust deeds. Ask me why not a second if the values are. Ask me, please. Help
Okay,
me.
why not?
The value is $500,000 on a property. The first trust deed's $295,000. They just want to borrow $100,000. There's still $100,000 in it after all. You just loaned them $100,000 because you're going to get $8,000 a year on your $100,000. But that's a taxable event, isn't it? Mm-hmm. That's exposure. Yep. But what else happens? They stop making the payment, or they get divorced. Now what happens? If you don't have the money to go to Umpqua or Umpar or whoever they're called up here, if you don't have the cash to redeem the first, you can kiss your second goodbye.
Gone.
First trust deeds only, friends. Never break the rule.
Yeah, good. That's really, really good advice. I like that. All right. Anything else you got to roll here?
Well, I'm just glad Michael's here and he's taken the time to take a look at our valley.
Yeah.
And turns
Michael,
out your dad used to own a lot of property throughout Oregon too,
A lot
right?
of property.
Right.
Can I tell you
So
the
would
story
you
how
look
we
at
started
that-
in Oregon?
Okay, yeah, I'm curious.
We're going on. We had a ranch in Idaho, a cattle ranch. Used to do calving in the winter. I'm not a spoiled kid from LA. I had to work and change fences and calve, and in the summer bale hay and change the water and the whole thing. And every time we'd come across the Oregon border, back in the 70s, there were these signs that said, "Californians, we don't like it, but you love your green." Remember those?
Yeah,
They wanted our money, but not us. And so when
Visit
my
the
dad
Dead
wanted
State.
to buy one of his Beaver coaches or the other motorhome, I forget what it's called, like a $500,000 tour bus for Rockstar tours. We bought a little postage stamp lot near that. When you come across the bridge of the Rogue River coming in, there was a tire I used to swing across as a kid into your river. And we went and bought a little postage stamped lot and got our mailing address, so my dad didn't have to pay the $23,000 in sales tax on his motorhome. And so the Democrats wouldn't indict him for mail fraud because they always looked at us all the time, couldn't put him in prison. We became Oregon residents when we purchased high-dollar vehicles.
Very
So
nice.
Bentleys and all those things were registered here. Then my dad started charging rock stars to use our address. Anyway,
It's a whole nother story.
yeah.
That's the real story.
That's the real
You
story.
only hear it here on the real estate show.
So what do you think about this valley? I mean, do you think of the Rogue Valley, Southern Oregon, that its potential? I mean, the housing is less here.
Let me
from
give you the
California.
parallel.
What do you
Orange
think it
County,
is?
Los Angeles, everybody's moving to Silicon Beach, all the tech companies. I'm going to talk to some guys. They're moving to LA. So you're a tech employee, you make $90,000 a year in LA. Why do you want to have an office building in Santa Monica where your $90,000 to $100,000 guys can live in a ghetto apartment in a horrible neighborhood? In Los Angeles and Southern California, where the bastion of technology markets are, the average income to rent a 3-bedroom, 2-bath junker home, we're talking in the hood, you have to earn $145,000 a year to rent a $3,400 a month home. Not own it, rent it.
Right.
Horrible. So this valley, you've got lifestyle. You can move up on the hill in a $500,000 home for $2,800 a month, cheaper than a 2-bedroom apartment in LA.
Jeez.
So companies need to move here and sell lifestyle and retain their high income employees.
We've completely
That's
changed
nuts.
that attitude about Californians coming here too, especially since we got our broker licenses. So we welcome you.
course.
Come on.
And
But it's
of course, as Dollar Brains, we have a division that we have a broker's license in it, so we co-op.
Yeah, and no problem there.
Well, we'll see what happens. I'm always curious,
Where can people get
this
more
leads.
information?
Yeah, how
Share
can
the
they
I'll
find
give you one more idea. You have a lot of people in this valley that maybe their kids are in their 40s or 50s, and grandpa and pops bought a lot of land. Now all of a sudden your land's starting to be worth a lot of money. Maybe you have a piece of property that's worth $14-15 million now. It was not split. But your family's never had income. You're hardworking people. You might be small business people. All the developers are circling you like hawks wanting to buy it for 10, but it's worth 14. And what's that going to do? The basis on it was $150,000. You're going to have a taxable event of about $13.8 million. Oregon taxes, federal taxes, FICA, and all your silent partners that done nothing
You
for
partner
you.
with them, right? And
Here's what we
it
do.
together.
You're that guy listening. You have some land. You get a hold of the guys on this show, and we will get together and we will bring in the money to spend the $5 million for infrastructure, tentative maps, all of the rezoning, all of the stuff to triple the value of your property, and we'll sell the developers pads off,
Right.
and we'll cherry pick and maybe develop the premium income immediate opportunities right off the bat. We'll go 50-50 with you, and we'll give you the original basis of the value of your derivative property, and we'll get some fees for it. But the bottom line is we'll double your value, we'll earn our keep, and we'll let your family reap the benefits of their holding.
There's so
Good
many.
stuff.
There's so many
Yep.
aspects to real estate and investing, and that's perfect there. It's dollarbrains.com is the website. Michael, thank you for joining us.
Thank
and,
you.
Good luck to you, and I hope I hope to see some of those projects. Don McCoy,
Great work.
Nice to
Yeah.
visit with
Thank you, Pete.
That'll
Thank you,
do
Joe.
it for the Real Estate Show. Have a great week, everybody, and God bless. We'll see you next Saturday right here on KMED.
You've been listening to The Real Estate Show on KMED AM and FM radio, presented by John L. Scott Real Estate of Southern Oregon, along with All Cities Property Management, the Home Builders Association of Jackson County, Ditech Mortgage, the Jackson Soil and Water Conservation District, and the Rogue Valley Association of Realtors. For guest information or to watch a past show, visit us online at realestateshoworegon.com. Join us again next weekend for Southern Oregon's one and only Real Estate Show on KMED.